Good morning, everyone. So, one of the things that has been popping up in my, questions that I've been getting from consumers day in, day out has been, what does the Fed raising rates have to do with the mortgage market? And who better to go and talk to but Jesse Regan over with Preferred Lending Solutions. My mortgage oracle, city councilman extraordinaire for Broussard. For those that aren't out there, make sure you go and give this man a vote. He is there for people. So, that being said, Jesse, thanks so much for joining us, man. We appreciate you coming on.
Good morning, Robbie. Thanks for having me. So, what have the Feds been up to? Well, let me start by identifying the number one enemy of mortgage rates. And this is a word that we've all heard this year in the news. We're also all feeling it at the pump, at the grocery store. And that word and that number one enemy is inflation. So, how did the Federal Reserve, what are they doing to impact the rates? Well, the Feds meet 8 times a year traditionally. They've already met 5 times this year. And of those 5 times, they've already raised the interest rate, the key interest rate 5 times out of the 8. So
explain that rate to everybody, because some people think that those are intertwined with mortgage interest rates and the Fed raising the rates.
So that's a great question. So the Fed's rate is the rate that banks are going to borrow money at and lend money at for short-term financing. Car notes, credit cards, variable interest rates on home equity loans, things of that nature. That does not have a direct correlation to your longer term interest rates, where are going to be your 10-year, your 15-year, your 30-year fixed mortgage rates. Now, the Fed rate does have an influence on it, but it's not a direct correlation. So the Feds have raised the rate 5 times so far this year. And the last 2 times they've raised it 0.75%, which is unprecedented. The last time they did that was in 1994. So they're really trying to combat inflation by being very aggressive, taking some bold moves to get those interest rates where they need to be to help quell that inflation.
One of the best ways I've heard, inflation being described was you've got too many dollars chasing too few products, which ends up bumping the price up of everything that's going down. And what the Fed's essentially trying to do is reverse that trend, is making it more expensive to buy those products. So it's going to essentially go and increase the supply chain, which will decrease the prices, which is what the Feds are trying to do. They kind of overcorrected a little bit whenever not a little bit, a lot bit whenever we did. And of course, they're going to try to overcorrect right now to be able to go and try to get this thing into control. So, with that impacting the mortgage rates, which is what we are here, where, what tools do you look at when we're looking at the market, giving clients and some advice to be able to lock in their rates?
Sure. So the mortgage rates are going to be tied to the 10-year Treasury note. That's going to be the driving force, that mortgage-backed securities. So as I've said in the past, the Fed was actually purchasing billions of dollars of mortgage-backed securities per month back during the pandemic. Well, since then, they've reversed course. Now they're starting to balance their balance sheet out, and they're starting to sell those same mortgage-backed securities. So what we monitor on a daily basis, on an hourly basis, is going to be your 10-year note and your mortgage-backed securities. So we watch for trends. So anytime that we have a pipeline, we may be floating, we may be carefully floating, maybe locking. So it's important that, us as mortgage brokers, we keep an eye on those key factors to make sure that we're taking advantage of those gains and getting those lowest rates possible.
When you say floating and carefully floating, for the layman out there, what does that mean?
Sure. So let's say you bring a contract to me, a signed contract, and a client looking to purchase a home. Well, we're going to initiate the process. We're going to get the loan application started. We're going to vet all of the income, assets, debts, make sure that we have a good solid deal. And I'll go ahead and disclose an interest rate, a worst case scenario on this interest rate at that time. But the market may be trending in a good direction. So we may just float the rate in hopes of getting a lower rate between now and the actual closing date. So when I say float or carefully floating, that's kind of the matrix that we use when we look at our pipeline on a daily basis to make sure that we're taking advantage of those dips, because it has been a roller coaster over the last couple of years. It's full of ups and downs. So it's important that we stay in tune with the market. That way we can lock in that rate whenever we hit that low on any given day.
Gotcha. So right now, we actually saw interest rates jumping up into the lower sixes about 2-3 weeks ago, maybe a month ago.
Yep.
We went from 2.8, 6.27 up to 6.25, 6.375. I don't know if you even had some that were at 6.5 in a moment, but where are they right now?
So yeah, that's correct. So about a month ago, we hit some 12+ year highs. I mean, we're in that 6.25 range, and that was really being priced in already. The Feds had come out earlier this year stating that they were going to increase the rate. So the mortgage market started pricing in that into the markets. That's why we saw that spike. They've since settled back down. We're now back in the 5.5% range. So they have settled back down. Of course, there's a lot of factors that play into it: credit score, loan program, down payment, things of that nature. But all in all, the national average is still going to be in that 5.5 to 6. So we are off of those highs, and it is trending downward. And it's important that it's not only what the Federal Reserve does, but it's what they say they're going to do. And they said that they're going to continue to do what they have to do to get inflation under control. But once the inflation gets to a bearable number, they're going to reverse course and start to reduce the interest rates. So with that said, I mean, I feel that we're going to hover in that 5.5 to 6% range for the rest of the year.
Gotcha. And moving forward, so advice that ends up popping up for our buyers. We got two sets of buyers. We got folks that have locked in at 6.25. I know you've been very proactive about renegotiating those rates to be able to take advantage of the lower rates. So I know those buyers are really thankful for that. Moving forward, some of the advice that I've been giving folks, and just correct me if I'm wrong too: marry the house, date the rate. We can end up we're in a unique situation right now where there's a lot of sellers that are not really panicking, but they're not quite as confident as what they are. So you're actually able to double dip. We got sellers that are coming down some and having some decent price adjustments on things that are coming, off the market, and we're able to double dip and get a little bit better rate. Would you say that's accurate?
That is correct. Actually, the pressure on the rates is actually healthy for the market because it allows that demand to catch up with the inventory. So, having record rates for 2 years, the housing simply outpaced the inventory. The need for housing simply outpaced the inventory. So this is healthy for the market. Having rates in that 5.5 to 6% range will kind of balance everything out. And as a homeowner, you'll find it easier to get contracts accepted without having to pay over asking price. You'll find that the pendulum is going to kind of swing from a seller's market to a buyer's market as these rates start to increase. So there's some opportunities there to get seller credits, to get contracts without having to go over asking price. So I actually find that it's healthy for the market to be in this range.
So I'm finding too, and just before you jump into into buyer's market, the thing that ends up having to happen, because it's all supply and demand driven. So 2020, when we went March 2020, when COVID was announced, up through about April, May, we had sales that essentially dropped completely because nobody knew what was going on. And then all of a sudden we went from, the leading indicators that I always like to look at are pending sales. Buyer and seller have a meeting of the minds of what's going on, and we have new homes that are coming on the market. Our new homes on the market went down, and our pending shot up 20% to sometimes even 40%.
It's crazy.
And what ended up happening, kind of just to piggyback off what you were saying, is this happened for nearly 24 months, back to 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 back. So in 2019, we used to have, on average, all of Acadiana would have 3,300 to 3,400 homes that were on the market. Lafayette Parish would have 1,800-ish to 2,000-ish, depending on where that happened to land. Today, even through a few months of 6%, 5.5%, 6% interest rates, today we're at 1,396 homes on the market for all of Acadiana. So that's 2,000 fewer homes to be able to choose from, and 680 for Lafayette Parish, and that's from 0 to $1 million plus. So the folks that are thinking that we're going to run into a crash, that's not the case. There's not enough things to be out there to be able to choose, at least for right now. What that happens. If there's nothing to choose from, you got 4 things to choose from, and they got 10 buyers out there. Doesn't mean you're going to be in multiple offers all the time, but you don't have a lot of things to be able to choose from. So jumping back in, we have to see a complete reversal. We have to see supply shoot up and demand fall through the toilet. This month, our supply dropped down. Hang on, let me get the exact number, so I'm not making myself a liar right here. New listings. We had 500 new listings in July 2022. We had 365 new listings. July 2021 was 500. July 2022 was 365. That's a 27% decrease July over July. We're down 11.5% as far as the total number of new listings taken. We're down 17% on the total number of pending contracts. So that's only a 6% jump. And I say jump, that's like a little hop as far as available inventory to be able to do it. So in order for, the market's not crashing if we don't have things to be able to choose from. And you could probably jump into mortgages are way harder to get than they were in 2008 when the market really took a nosedive.
No doubt. That was an absolute market correction whenever we had that mortgage crash back in 08. I just made 18 years in the industry. There's full of ups and downs, and they're going to continue to be. So I do not see a crash. I do not foresee that. I think that we're going to find a new norm or a healthy medium, being in that 5.5%, 6% range. It's great for everyone. It's great for the market. So I do not see a crash as well. Unfortunately, there's no crystal ball. There's a lot of factors that play into it: geopolitical, the Fed meetings, inflation reports, economic reports. All that's going to play into it. But the Feds, their monetary policy currently is to really suppress demand, because demand has been so hot in so many different sectors, not only the housing sector. So their bold moves are to suppress the demand and likely push us into a recession. So it's almost intentional, because they want to get us into that recession, push us over the ledge, but right away they're going to reverse direction, start reducing the interest rates to make sure that the recession isn't as long and too painful. So just think of it this way: it's short-term pain for long-term gain. Still a great time to get in the market. Rates, historically speaking, are still low. Like I said, I've been doing this 18 years, and we were well over 7% when I first started, and the market was strong then. So we still have great opportunities, even with the rates the way they are.
What's also interesting, even though we're not calling, the Feds are not Feds, politicians aren't calling things that are a recession, which we're getting close to be able to jumping into. Housing actually outperforms the market when it comes into recessionary talk. The prices tend to still go and outpace the market and end up being a little bit better, ends up being a better investment long term. There may be a little bit of dip. I would tell you in closing, for folks that are looking to go buy something and turn around and move out in 6 months or a year, it doesn't matter what market you're in, it's always risky to be able to do that. The folks that are going to be in there 5 years, 7 years, 10 years, you're going to be safe no matter what, because the market's going to go up, it's going to go down. You're never going to catch you never catch a falling knife. You're never going to be able to tip that basketball on the apex whenever the ref lobs it up for a jump off. So that's one thing I would end up. And I would ask Jesse too, if how would somebody end up taking care of market or taking advantage of some market trends that are coming up?
So be prepared, be proactive. As an investor, keep your eyes open for opportunities. Know your return on investment. Know where you want to be. Know what price range you need to be in, what rent you need to get to be able to make the numbers work. As a homeowner, get all your ducks in a row. Get pre-approved. Be positioned to be able to pounce on those opportunities as they come up, because we don't know when it's going to flip. When it's going to teeter out, and we're going to have the inventory and demand kind of equalize. So you just want to be prepared for that. So I'll kind of and have a clear picture on what you want, know your budget, and then that way you can communicate with your trusted realtor that is going to be out there looking for you daily, and you can jump on that opportunity. So I would reiterate what you said, Robbie. Fall in love with the house, not the rate. Lots of ups and downs. Keep in mind, you can always refinance in the future. You can pretty much streamline that process, hopefully get an appraisal waiver, keep your closing costs down. So fall in love with the house, not the rate. Know that we can refinance in the future. And if you get into a rate lock and the market dips in 30, 45 days before closing, we can always renegotiate that rate down to get you that lower rate and not have to start the process all over again.
That is one thing that I'm running into, at least on the real estate agent side. Man, I'm worried about the rates. I want to wait for them to come down. Mm-hmm. You do have the opportunity, should it happen to pop up, to be able to renegotiate. And I think that's super important for everybody that's watching out here to make sure. So Jesse, I know we're running out of time. Where can they find you?
You can find me at jesseregan.com, or you can find me at donedealnow.com.
Awesome. Thanks so much for joining us. And everybody, if you got any questions, interested in looking to see what your equity position happens to look like, you can shoot me a direct message. If you're looking at reaching out to Jesse, of course, check him out, jesseregan.com. Thank you so much for joining. We'll see you next time.
Thank you, Robbie.